Good morning, everyone. My name is Jan-Hendrik Pretorius. I just finished with my master's in economics at Stellenbosch University, and I'm currently also busy with my PhD in economics at Stellenbosch. Today, I'm here representing Codera Analytics. I'm employed by them as an economist and a data scientist, and I'm presenting our paper, our policy paper, Gaps in the Inflation Targeting Debate in South Africa, co-written by myself and three colleagues, Aidan Horn, Lisa Martin, and of course, Don Steenkamp, who I'm sure many of you are familiar with. But essentially, on my way here, just as a quick interjection, I was a bit concerned that my presentation shirt would be a bit crinkled due to the flight. I called my partner and he said there will be an iron in the hotel room that I could use. There wasn't. But if you are willing to listen to me in my crinkled shirt, hopefully you will also be willing to read our paper, which contains more than 40 different graphs regarding the inflation targeting problem in South Africa. And one of the things that we discuss is, among others, what the optimal inflation target in South Africa ought to be. And in general, we argue that a lower target is desirable. However, we also discuss some other practical implications of lowering the inflation target in South Africa. And these are the 5 questions that we follow throughout the paper. So we also argue that there are a bunch of aspects of the nature of inflation and price setting in South Africa that have bearing on what the optimal inflation target ought to be. So we go into a lot of considerations regarding what the cost of transitioning to a lower target would be. But we also argue that the SARB, or South Africa in general, policymakers need to focus on these 4 considerations when we do eventually adjust to a lower inflation target. Now, we argue that achieving a low cost and sustained decline in inflation requires these 4 things. And we discuss the relevant theoretical literature in the paper as well. But essentially, one of the big arguments in the paper is that South Africa has incredibly high structural inflation. And we need to take in a whole bunch of different considerations when we do transition eventually to a lower target. But the important point is that inflation is contributing to an ongoing decline in relative competitiveness in the economy as the nominal exchange rate depreciates, while the real effective exchange rate has remained quite consistent over the long term. The implication is that we lose relative competitiveness with our trading partners. And this is to say that our exports are not becoming more competitive, right? South African consumers end up not just paying more for imports, but essentially we also struggle to keep up with the kind of costs that our trade partners are facing. And so we argue that there would be benefit to South Africa from having a low inflation target, and one specifically that is more aligned with that of our trade partners. And so we argue in the paper that there are various domestic considerations that matter for the appropriate target and how the target should be defined. In the interest of the presentation, I'm only going to touch on a few of these considerations. But please do go read our paper for a bit more of an in-depth overview of these considerations. What we found is that South Africa faces persistently high structural inflation, but it's not just high, it's also very uneven, with significant dispersion across components and clear signs of asymmetry. This pattern is largely driven by a few key forces: government-administered prices, imported inflation, recurring supply-side shocks, and high levels of market concentration. Adding to the challenge, inflation expectations in South Africa remain backward-looking and are unanchored. What we argue in the paper is that South Africa has had high structural inflation, and this inflation is quite variable. The structural inflation hasn't only been driven by food, fuel, or utility costs. In fact, a wide range of domestically determined prices, like education and insurance, also drive a lot of the inflation that we see in South Africa. This suggests that structural pressures run across many parts of the South African economy. And this chart shows the contribution of the exchange rate to fuel price volatility in South Africa. And this ties into the argument that our persistent exchange rate depreciation has not only contributed to a lot of the volatility that we see in the fuel price, but what we also see is that there are some meaningful domestic factors that also run into the increase in the fuel price, or fuel price inflation. Specifically, administered prices or costs like the road accident fund and transport costs play a big role in determining domestic fuel prices. But it's not just exchange rate depreciation that drives inflation. We see a much bigger increase in domestically determined components like the road accident fund, transport costs, and though these things are related to fuel prices, they themselves are a largely domestically determined component. And in fact, this domestically determined portion of fuel prices make up about half of the retail petrol price. But this plot specifically tells the story quite nicely. Administered price inflation has been consistently above the midpoint of the inflation target and has even been volatile over the past 2 decades. In the paper, we also argue that administered prices make up a large proportion of the total CPI basket, which is about 30%. So given that administered prices make up such a large portion of inflation in the country, we also discuss some dispersion across price categories in the paper. It's no surprise that many individual price categories sit well above the upper bound of the target range, and this chart specifically shows how widespread that pressure is. Across the hundreds of components in the CPI basket, we see sustained high dispersion, especially in tradables like petrol, administered prices like electricity, and even in some food categories. This complexity matters. It means that the Reserve Bank can't rely on a single inflation number, and policy needs to be informed by a clear understanding of how different prices are set and how shocks in one area of the economy ripple through to different areas. As we discussed in the paper, the best time to lower the inflation target is during a time where trend inflation is low. And this is particularly because, if we look at the kind of inflation that we have in South Africa, structurally high, backward-looking inflation expectations and unanchored expectations, we would need to keep the inflation rate quite low for a long time before South Africans can credibly believe that we're shifting to a lower inflation target. But one of the things that we need to do is that we need to find a good measure of trend inflation. And of course, trend inflation is unobservable. But the fact of the matter is that many of the inflation measures that we currently have do better, marginally better than others, but significantly, very few of them perform exceptionally well. And more particularly, none of the current inflation measures that we have could have predicted the post-COVID spike in inflation. So our paper also examines alternative core inflation indicators, including the CPI common, supercore, and trimmed mean measures. And the big problem is that this calls into question the reliability of the existing core measures as guides for monetary policy. The next question then is, if SARB does choose to lower the inflation target, what are the costs? And here the answer, as we argue in the paper, are quite simple, that it depends on inflation expectations. Like I touched on for the previous slide. This is relevant because interest rates will need to be kept higher for longer to hammer down inflation expectations if they are backward-looking. Though if they are forward-looking, essentially we can just tell people that we are lowering the target and everyone's supposed to believe you, right? But in the paper, we argue that South African expectations in terms of inflation are unanchored and are backward-looking. And we also see this exact same trend in wage expectations. While the public sector wage has declined significantly post-2021, private sector wages have had the exact opposite trend, increasing far beyond the midpoint of the target range. Transition costs are unlikely to be zero. In the paper, we also estimate a Phillips curve for South Africa, and the estimates show that because we don't have forward-looking estimates, we must keep the inflation target, we must keep inflation below the target for quite a long time before we can transition to a lower target with minimal costs. And I do know that this might be the most controversial figure that I have here. I mean, we've got upwards of 40 economists in the room, and each one of you will probably give us a different Phillips curve. But the fact of the matter is that these are some of the findings that we have in the paper, and in particular, we estimate something that is quite similar to what the IMF has been telling us about inflation expectations in South Africa. But the benefits of lowering the target will depend on how much term premia fall. Successfully lowering the target would lower expected inflation, which would be expected to contribute to lowering long-term nominal interest rates to the extent that inflation risk premia fall. But a worsening of government finances could move rates in another direction should credit premia rise. Another important consideration for the appropriate inflation target and the measure used to define it is the relationship between the experiences of firms and households. In particular, we see that the poorest decile of the inflation basket, or CPI basket rather, experience much different kinds of inflation than the richest decile. Now, this, of course, is not new news. But we must consider these kinds of things when we do eventually move or decide to move to a lower target. And this is bearing for the way we communicate to different expenditure groups. Now, of course, we do have some policy implications from our discussion paper, but specifically, another quick interjection. Right before we came, when me and my colleagues, our co-authors, were discussing the paper, one of my colleagues used an AI chatbot. It's one of these new things where they generate a podcast episode. And he gave our paper to the AI and generated this podcast episode. And in particular, these things are quite cheesy, but one of the things, it is cheesy, but I think it works quite nicely in the context of our paper, is the fact that we need a Team South Africa approach to lower the target. The fact of the matter is that a large component of the volatility and of the high structural inflation that we face is government-administered prices. We estimate about 30%. If we do decide to move to a lower target, the cost thereof will depend on whether we can get the government to buy in. We need some supportive fiscal policy when we do move, and the fact of the matter is if we cannot get fiscal policy to work together with monetary authorities, that the costs are likely going to be higher. The question then is, when should we do this? And like we argue in the paper, the optimal time would be when inflation is a bit more anchored, when inflation, high structural inflation, has been brought down to a lower level, and then eventually we can think about moving to a lower target. Thank you so much for listening to me, and I look forward to taking your questions. I think it was quite a quick presentation, so there should be enough time before Hilton can start setting up.